Deficits are still dangerously high. Debt is over the top. We're monetizing debt at a faster rate. So until one of those things changes, then I will say, well, maybe this is the end of the bull market in precious metals. As of right now, it's just a necessary sell-off.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for October 20th through October 27th, 2025, while supplies last. First this week, 1 ounce gold Philharmonics are just $99 over spot. Next, 2 ounce silver Canadian Rocky Mountain coins are only $4.50 over spot per ounce. Finally, kilo silver Britannia coins are just $2.99 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. It's been too long since we've had this returning guest on. Michael Pento, an active money manager at pentoport.com, joins us this Tuesday, October 21st, 2025. Michael, thank you for coming back on Liberty and Finance.
Always good to see you, Dunagun.
You've got a new background there. I understand you've just moved to a different location in the same area of Florida that you've been in. We've, like you, have been enjoying our change to Florida from where we came from in terms of lower taxes and a liberty-minded leadership and rules and that sort of thing. So delighted to see that you're still here, and wanted to get your outlook on leading indicators that you're watching in the economy. Our viewers are intently interested in the direction that the markets, the Fed, precious metals are heading, and we've certainly seen a lot of activity across all of those spheres. You can start with any one of those three, and I'm sure it'll lead us to the other two. So go ahead and let us know what the key things are that you're keeping an eye on at this time.
So we have a huge correction today in the precious metals sector. Silver's down over 8%, gold down 7%, platinum around 8% as of this recording. And so you have to ask yourself, is this some kind of watershed moment in precious metals? Or do you just let your phone ring?
Well, I'll tell you that my phone's been ringing off the hook. It's almost melted today. In fact, I probably should charge it up because we have...
Is it because people are buying?
Yes, that's right. We have a lot of clients who have been waiting for a pullback, feeling especially those who have been buying for years, know that, and I know when the market has a down day, I'll hear from specific individuals who always are value conscious and they're looking to add on pullbacks. But go ahead.
So you have to evaluate, is this a trenchant watershed moment, an epiphany in the precious metals market? Is the bull market over, or is it just a healthy pullback? And nobody knows for sure at this moment. God only knows, and I'm certainly not him. But I will tell you this, what has really changed? And the answer is nothing. We had a secular bull market in precious metals that went vertical. It just went linear. And in my opinion, at this juncture, this moment, it's a healthy, necessary pullback in the bull market of precious metals. Because look, I mean, here's the facts. The Fed is panicking now. They're actually in panic mode. They're not panicking to raise interest rates. They're now going to actually accelerate the monetary debasement of the dollar because they're cutting interest rates. They're going to cut again next week, second time. This is before the new chair comes in May of 2026, who's going to cut rates even more aggressively. The Fed is ending quantitative tightening. As a matter of fact, I checked yesterday. I looked at the Fed's balance sheet. Quantitative tightening means you're actually shedding assets, so you're draining the balance sheet. The opposite is, since October 1st, the Fed's balance sheet has been increasing. So they're already in the process of quantitative easing, and I think that accelerates under the new Fed chair. It coming in 26. And then is China now selling gold to stockpile treasuries? Is Russia doing that? So I mean, so there's nothing really changed. Has the United States paid off its debt or deficits? The deficit this year is the same as it was last year, despite all the revenue that we're taking in tariffs. It's the same number, $1.8 trillion. That's not my opinion. That's a fact. So from the Congressional Budget Office. So deficits are still dangerously high. Debt is over the top. We're monetizing debt at a faster rate. So until one of those things changes, then I will say, well, maybe this is the end of the bull market in precious metals. As of right now, it's just a necessary sell-off that should be bought. Now, if it continues to erode, you're going to break some support here, and it might last longer. It might be a significant pullback. But at this moment, it's a very healthy correction.
You know, the criteria that you went through of the fundamentals are the same ones that Rick Rule has brought up time and again when viewers have asked the question of him over the years, when are you going to sell your gold? They're always looking to him and you, as you guys are always looking forward. He is a value investor, so he loves to get into sectors that are hated. He loves to lead the crowd, and then when the crowd finally, confirms what he knew all along, then he starts to taper his way out. So that question comes up is, what are the things that he's going to watch for? He said, I'll tell you what I'm going to watch for. I'm going to watch for the end to debts, runaway debts, deficits, negative real interest rates. Those are the first three things that he mentions, and the debasement of the currency. So you've gone through the same analysis and come to the same conclusion.
Separately. Yeah, I didn't know that I don't know he did that, but yeah, negative. We have positive real interest rates at the moment, but very marginally so. But it's not the rate. It's not the level. It's the rate of change. So the rate of change is going in our favor.
Yeah, well, that's the other thing is he talks about the real, and you have too, talking like shadowstats.com, John Williams there saying we're not at this, whatever the Fed claims, 3.6% or something. And you'll tell us more what the Fed claims the rate of inflation is, but they have to cook the books to get that number, that it could be 8 to 10 or plus percent. What are you looking at as far as the real rate of debasement of the currency when you're not moving the goalpost, as the Fed tends to when they don't like the number that they come with using the old methods?
Well, I mean, I don't have a number for you. I just know it's much higher than the hedonically and substitutionally adjusted. Who cares? Does anybody invest looking at the CPI? I look at the rate of change of things. Actually, the second derivative is the most important thing to me. So it's the rate of change of the rate of change. And for me, it means that inflation is heading higher at a faster rate. So we're growing at 2.7% year over year now. This next print, whenever we get it, because the government's closed, but we're going to get a print on Friday. And I think it's going to be 3.1%. That's higher than 2.7. So the rate of change is accelerating. And yet we see the Fed, for some unknown reason, is anxious and now panicked to cut interest rates, end QT, and re-enter QE. Even though we spent 4.5 years above their silly, ridiculous, derisive target of 2%, and we're 50% above 2%, heading further away from 2%, and they're cutting interest rates.
Yeah, that tells you there's something else going on. It's always like, watch the body language. Don't listen to listen to the words just to hear what the cover story is, but not to understand what the truth is. Watch the body language.
That's why people turn to you, Dunagun, and Liberty and Finance, because you won't hear this from the financial media. The reverse repo facility. This is basically the excess reserves from banks that they didn't need and they parked it at the Fed. And that was used to buy treasuries to make sure we had quiescence in our bond market, even though we're an insolvent nation. That was $2.5 trillion in 2022. Well, today it's effectively zero. So the Fed knows that all of that excess liquidity that the banks had parked at the Fed is now gone. So they don't want another repo crisis like they had in 2019. We're on the the threshold, the doorstep of another one. So they're preemptively, obviating the need for that aggressive rate cutting and to, spike the balance sheet by $1 trillion. They're trying to get ahead of that by now ending QT, lowering interest rates, and rebuilding the balance sheet. It's funny that the balance sheet was $700 billion prior to the global financial crisis. It spiked to $9 trillion. They managed to get it down all the way to $6.3 trillion. From $700 billion to $6.3 trillion. And the reserves in the system were almost negligible, almost zero. And they spiked through. As a matter of fact, I'm going to put on my web, as part of my midweek reality check this week, I'm going to put a chart up of reserves in the financial system and show how they spiked from like zero to over $3 trillion since the global financial crisis, and then really went ballistic after COVID. And there's still, a superfluous amount of reserves in the system, and yet they're adding those reserves. So you want to understand why people are pining for an alternative to the US dollar, and they're running into this like crazy stuff like Bitcoin. But in reality, what they need is gold and silver and platinum. And that's what's happening. So that's why I think, again, as of now, it's just a healthy pullback in the precious metals complex, which if you have the courage to step in when silver's down 8%, you might be rewarded a few weeks from now.
You mentioned this repo crisis that was happening a few Septembers ago, where the overnight rates went up to shot up to 10%, and all of a sudden the floodgates opened and there were unlimited windows of credit lines available and so on to the banks to help paper over this interbank distrust crisis. And now, just as of last Friday, there's a new, amount that has just been released, and the fund reminding everybody that, hey, we got $500 billion or $500 billion sitting there ready and waiting for repo liquidity. Can you underscore how significant it is to hear that message being repeated at a time when we're also being told by officialdom, strong economy, things are good, etc.?
So inflation's been above the Fed's target for 4.5 years. We've got record asset prices in stocks. We have a huge, tremendous housing bubble, a massive bubble in credit. And yet the Fed is preparing to dump, helicopter money along with the Treasury. In fact, the Treasury is talking about, along with the administration, another round of helicopter money, another stimulus check for $2,000 worth of, America coin, whatever, in cryptocurrencies. This is lunacy beyond belief. And of course, people are looking and seeking shelter in precious metals, and they should, because we are an insolvent nation. And the only thing that's I will say this, the only thing that's going to end this bubble is going to be a combination of, yes, we are insolvent, we know that, but you need also insolvency and inflation to run intractable. I think that's what's going to occur. We're going to set ourselves up for intractable and protracted stagflation, which is going to lead to a bond market crisis. So in other words, you're going to have panic selling in the Treasury complex, not just because of a repo crisis, because there's no liquidity, because they're going to supply liquidity, as we just talked about. But then the liquidity is coming on top of an inflation problem, and you can't solve an inflation problem by creating more inflation. So there's a very high probability that you're going to see a bond market crisis that is not engendered by liquidity, but engendered by insolvency and inflation. And then that's the cue for me to get the heck out of harm's way. I mean, just go and short the market, go into cash, go into T-bills, and go in and short the market. Because there's nothing the government can do. Dunagun, what does the government do when there's a crisis? In the past, this nation has done two things. They've printed a ton of money, and the Fed has monetized that money to send to people, send to banks or send directly to individuals. But when your problem is already inflation, you're only going to exacerbate that inflationary problem. So there is no solution from government. The only solution is to reset the currency and to default on debt. And that comes after hyperinflation, which is also a very, unfortunately, and incredibly, it's a very real possibility in this nation.
You're going right where I was hoping we would go with this, and I'd like to probe your thoughts on this, because you, as an active money manager, are shepherding the funds of many, many, many moms and pops and small businesses who have a nest egg that they'd like to protect and grow to provide for their financial future. What about the standard approach that's been used for the past 40 years by retail financial planners and advisors, whom you, in a sense, are in competition with by being an independent money manager, who are telling people, look, we're going to hold to the plan. The plan is buy the dips on the market, 60-40 portfolio of stocks and bonds, and we're going to ride this out, and the market always comes back and you make 7% on average year over year, and everything's fine, and they're going to keep on keeping on. What is it that most people are not hearing from their financial planners that they need to know at this time, and what the financial planners doing and looking at that isn't going to work anymore because the rules of the game have changed?
2022 should have served as a valuable lesson to most of these Like I got 95% of Wall Street are just used carpet salesmen. They're not really managing money. They're just gathering assets. They're gathering assets, and then they're looking at your age, or if you want to take a trip to Africa, or how many kids you want to have, and then try to come up with a combination of stocks and bonds. So just say the 60-40 portfolio. And then they sell you buy and hold that. They try to like closet index the S&P 500 with the equity portion, the equity sleeve. And then they just say if the market falls, well, it always comes back. Well, 2022 should have, disabused us of that falsehood, because 2022, both stocks and bonds cratered. And the reason why stocks and bonds went down is because bonds yielded almost nothing. They were in a massive bubble, and they still are. I mean, it's gotten a little bit better, but they're still in a massive bubble. Credit is in a bubble. And then the equity market is in the biggest bubble in history. We're now 220% total market cap of equities to GDP. And if you look at every other metric that you can possibly think of, price to sales, Cape-Shiller, risk premiums, they all scream that this is the most overvalued, overly concentrated, with the Mag 7 being 34% of the index, over-owned. The household net worth has more a highest percentage of assets in the in equities as they ever owned before. It's also the most over-leveraged. One of the charts that I'd like you to look at with my presentation, if you subscribe to my midweek reality check, which again, that's a free trial and there's $50 a year. One of the charts I'm going to put up is the FINRA margin debt to GDP, which is, a standard deviation higher, 2 standard deviations higher than the average. So it's the most over-concentrated, overvalued, over-owned index we've ever seen, over-leveraged index we've ever seen. And it's going to correct in a big way. If you go out 10 years, the average return over the next 10 years should be minus 0.5%. So you're talking about losing a half a percent every year on average. But then again, the market doesn't work like that. So it's probably going to keep going up until it crashes, down 60% or so. And you got to get, 100 and something percent to get back to even. That's what it's probably going to look like over the next decade. And if a 60-40 portfolio guy says, well, don't worry, it always comes back. Well, ask the people in Japan. I've said this before, but it bears repeating. I mean, we're not immune from the laws of supply and demand and macroeconomics here. It took 35 years for that index to recover from its bubble high. The Shanghai exchange is still down about 45% from its 2008 high. It took 15 years for the market to recover post in the Great Depression, the 1929 debacle. And as I hopefully eruditely described before, if stocks and bonds are in a bubble, a massive bubble, and credit is a bubble, and housing's in a bubble, we've never had such a bubble, the triumvirate of bubbles, that they all burst, and there's nothing the federal government can do about it because it's bursting because of insolvency, debt, and inflation, then it might take decades for you to get back to even in nominal terms. You could just cancel your retirement if that's the case. And we don't want to do that here. We have a smart way of looking at things. I have in my Pento portfolio strategies, we have a 5-sector spectrum that ranges between deflation and intractable inflation. Looks at the second derivative, so it's the rate of change or the rate of change. And it informs me what stocks should I own? What stocks and ETFs should I buy? What bonds should I own? Should I own treasuries, T-bills, or should I be shorting bonds? What commodities should I own? What currencies do I need to own? And if you understand that, you can ask yourself this simple question. This is a scenario. In a deflationary bust of the economy, a deflationary depression, you would want to overweight fixed income, right? And you want to underweight the highly speculative stocks which have led this market. The market has been led by the unprofitable Russell 2000 companies. That's emblematic of a bubble. And on the other side, if you have runaway inflation, stagflation, intractable inflation, you would not want to own any fixed income. You'd want to be shorting bonds, which is what I will do. And you want to own precious metals and base metals and energy. and avoiding the dividend payer. So it's what stocks, what bonds, what currencies, what commodities do you want to own in what regime, in what macroeconomic regime. That's what I do. And in that way, you can avoid the deflationary credit crisis busts, but also participate in bull markets in the correct style factors and sectors.
That's part of what you do then as an active money manager, is look at all of these different sectors that are available, try to position people ahead of time to be in the right places to benefit from the changes and minimize the amount that they're hurt by it, rather than just be like sheep in the headlights or staying on the train tracks when the train's coming and the whistle's blowing. It certainly seems to be one of those times. And it seems that international central banks and foreign holders of U.S. bonds are taking protective actions, whereas most ordinary mom and pop Americans haven't yet. Any comments on that? Why is it that foreigners seem to pick up on this and make the move first and leave the domestic people are the last to find out?
Dunagun, we've been inculcated by the Federal Reserve and Treasury that, listen, even if something goes wrong, we all acknowledge that recessions and credit crises, things can break, and they will. I mean, one of the charts I'll show you on my presentation in the midweek reality check will show you how over leveraged we are as an economy. So just to let you know, total non-financial debt, which includes state, local, federal government, private debt, it includes every debt you can think of: student loans, credit cards, consumer debt, household debt, mortgages, everything but bank debt. If you look at that nominal number, it's all-time record high, through the roof, like $77.9 trillion. But even as a percentage of GDP, it's higher today than it was in the global financial crisis in 2007, just prior to it, and much higher than it was in 2000. So we just have a debt-saturated, debt-disabled economy. And if you want to just buy and hold this, it's because of laziness. If you want to put your money with a money manager who's just going to come to your house and have milk and cookies and hear about your vacation plans, well, who gives a darn what you want? I mean, the market doesn't care what you want it to do. I care about your suitability for the portfolio, but I don't want you to tell me that you have to be really hyperly aggressive in the stock market when we're heading into a recession and a deflationary bust, because you want to take a trip to Africa. I'm mimicking one of those commercials that tell you, it's just not a prudent thing to do. So you have to tell it, the market's going to do what the market's going to do based on the macroeconomic backdrop, and you have to allocate your portfolio towards that. And it's nothing but laziness, slovenly, to sit there and take people's money and say, I have your money. I'm going to plug it into this model of just like 60-40, because I know that the bonds will offset the stocks to some degree, even though they're both in the bubble, and that's not true. Because you're really just a salesperson and you don't want to hear from your clients. You hope it works, but you're really just trying to sell the next customer about your portfolio. You're not really you're not a stock market analyst. You're not an economist. You're a salesperson. That's what most of Wall Street is. I have plenty of friends in this industry who just, hey, you can't time the market. Who cares what the market's going to do? Just make sure you try to closet index the S&P with your equity sleeve.
We've both mentioned a 60-40 portfolio because that's been the standard offering or recommendation of retail money managers for moms and pops for decades. Morgan Stanley, interestingly, about a month ago, came out with this revised, that they've never had this before, a 60-20-20, saying 20% gold to replace 20% of the bonds in your portfolio. And then we've had others come out and say, no, it's 25-25-25-25 with short-term T-bills and gold in there. Any thoughts from you on that? You're finally seeing an admission by officialdom that maybe you want to consider that.
Well, that's part of why we're having a sell-off today, because we see, it's not really in sturdy hands. This is not China dumping their gold reserves or Russia dumping their gold reserves. This is some kind, weak hands that said, listen, I'm up 100% in my precious metals miners, and I need to sell because I'm kind of panicked because they're down a little bit today. But in the long run, listen, I've been in this business for 30, how many years have I been in the business for? 35 years almost now. I remember decade after decade where gold was hated. It was derided. Nobody owned any gold. We're just seeing the incipient inclusion of gold as a genuine ballast to your equity and bond sleeve. It's a genuine offset to occurrences that would make bond prices go down and stock prices go down. It's a genuine ballast in your portfolio, and it's a necessary sleeve in anybody's portfolio. It's been that way for me for decades, but now it's finally being embraced incrementally and on the margins by Wall Street. It's still nothing compared to what I think how much they're pushing cryptocurrencies. It's still, you know why? Because gold is the great revealer, Dunagun. It makes governments and Wall Street look like fools. It unwraps the folly of government and big banks. That's why they hate it so much.
Yeah, we've heard a lot of different metaphors. Gold as the truth serum, or gold as the kryptonite for destruction of fiat currencies by the government, who are. That's the history of fiat currencies. If people haven't checked out Mike Maloney's series on the hidden secrets of money, it's really worth watching. It's about a 10-part documentary, very well produced. Check it out, Mike Maloney's Hidden Secrets of Money. He talks about from the Roman Empire and the Egyptian Empire and all the way to today, every empire that falls into this tempting pit of relapsing and going, okay, we're not going to have real money. We're going to have fiat currency, and we're going to over debt and over inflate, that kind of thing. How that plays out for the ordinary people that are holders of that currency. Any comments from you on that? We've seen this story before.
There's nothing new here. I mean, every fiat currency that's ever existed has gone to zero. So I don't think there's going to be anything different about the U.S. dollar. But at least, if you don't believe that, the very least you could say is that the U.S. dollar is going to lose its world reserve currency status, and it will. And people say, well, when is it going to be replaced by the yuan? China doesn't have a free-floating currency. Well, listen, it's going to be replaced by, and it's being replaced by, gold. Because gold is not, if China sells us excess goods and they have a currency surplus, and they used to want to park it in treasuries, which are backed in dollars, and those treasuries and dollars are now subject to tariffs and confiscations, and they say, well, wait a second, I'll just take my surplus and buy gold, and I will hold it myself. And that makes a lot of sense. It always makes some sense, because the United States can't steal China's gold. But you know what? It makes a lot of sense. The most sense is when the government of the United States is bound and determined to reduce the interest rate on those reserves. So it doesn't make any sense to park your reserves in treasuries that are on their way yielding back to 1 or 2%. It's just not worth it when you have the currency translation and you have the risk for confiscations. So it makes much more sense to hold your money in your possession in gold. And I don't think that's changed. I don't think that rationale has been disabused.
Michael, for people who want to take advantage of your free offer to get a sample of your midweek reality check, how can they get connected with you?
So the website is pentoport, Port.com. And on that, you'll see the midweek reality check tab. And you could just subscribe to I think it's 4 or 5 week free trial subscription. And if you like what you hear, then you'll get my honest, unbiased, objective analysis of the most salient economic data of the week, even though we don't have any economic data coming out because the government is shut down. You'll get that information. And I especially like what I'm doing this week, because I have, excuse my voice, but I have a very brief narrative that goes along with the charts that I'm going to send, and that's free to everybody that I compiled. It's 9 charts. I think you'll enjoy it. I think you'll be scared and frightened by it, but it's important to understand, how we've engendered this massive bubble, its manifestations, And then hopefully listening to great interviewers like yourself and listening to Liberty and Finance, you don't have to sit here and be a victim. You don't have to be a victim of the 60-40 buy and hold portfolio. There's things you can do. You can go out and buy gold when it's on sale, buy gold and silver and platinum when they're on sale. As I've done from you, and I'm very happy with your services personally. I could, you didn't pay me to say that, but that's just a fact. Happy with the price, happy with the execution of what I bought from you. And you don't have to hold anything. I mean, I always recommend holding 5% of your assets in gold, but you can go overextend in gold too. So there are times you want to overextend in gold like we are now, but might be some time in the future when we reset the currency and we have some sanity in Washington, when we have low taxes, low interest rates, low inflation, the stable currency, and you might not want 20% or 17 or 15% of your portfolio like we are now in precious metals. You might want a little bit less, but you should never wed yourself to a 60-40 or 70-30 or 50-50 portfolio ever. Because it used to work decades ago. It doesn't work when both those asset classes are in massive bubbles that will mean revert. And if you look at these charts that I'm sending you, when they mean revert, it's going to destroy people's lives. And you don't have to be a part of that.
Folks, if you don't want to miss a single episode with Michael, I'm also reminding you to just get on our free mailing list. If you go to libertyandfinance.com, that's all spelled out, all one word, libertyandfinance.com, put your email address in, click submit, and make sure you confirm on the confirming email. You'll get one email in your inbox per day. We won't share your email address with anyone. It's completely private, and we won't spam you. It'll only be one per day. And it will be every interview with Michael and all of our other guests and any weekly special, so you won't miss a thing. And it's completely free. And just, Michael, thank you for joining us once again on Liberty and Finance. We got to get back on your calendar sooner next time than we did this time, so that we don't because things are happening, things are moving and changing quite rapidly, and it's helpful to have someone in our corner like you who's looking forward and helping us to see what's maybe obvious to you, but not obvious to everyone. Just thank you always for being here with us on Liberty and Finance.
My pleasure, Dunagun.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for October 20th through October 27th, 2025, while supplies last. First this week, 1-ounce gold Philharmonics are just $99 over spot. Next, 2-ounce silver Canadian Rocky Mountain coins are only $4.50 over spot per ounce. Finally, kilo silver Britannia coins are just $2.99 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.